You spend months building up your new online business, right? You're finally getting traction, the orders are rolling in, and you're packing boxes late into the night.
It's an exciting time.
Oh, it's totally exhilarating.
Right.
And then, click. You wake up one morning, you try to log into your seller dashboard, and your Amazon or Flipkart account is just suspended. Your income stream literally drops to zero overnight.
Yeah, it's a devastating scenario.
Yeah.
And um, what makes it incredibly frustrating is that for thousands of sellers across India right now, this is happening all because of a single, deeply ingrained piece of bad advice.
Right, specifically regarding their sales turnover.
Exactly.
So if you are launching a dropshipping store or selling on a major platform right now, there is a very good chance you are walking straight into a trap that will shut your business down. And that is our mission for this deep dive.
We are unpacking the radical transformations in India's GST landscape for 2025 and 2026.
Right, because things have changed fast. We've pulled together the latest tax compliance manuals, startup portals, and e-commerce seller guides to figure out the actual mechanics of what is happening here. I'm coming at this from the perspective of a tech-savvy entrepreneur who just wants the practical operational realities. Like, what do I actually need to do?
And I'll be looking at this from the perspective of the tax authority, the analytical architecture of the system itself. Because we need to look beyond just what the new rules dictate and examine, well, why the system is engineered this way in the first place.
Right, getting into the government's head a bit.
Exactly. Once you map out the underlying logic of their data collection, the intense compliance requirements suddenly make complete sense.
Okay, let's start with the big misconception that is getting everyone banned. There is a scenario in our sources that is going to sound painfully familiar to a lot of people.
Oh, the Rahul example.
Yeah, let's call him Rahul. So he starts selling phone cases online in January. By February, he's done about 40,000 rupees in total sales.
Which is great for a first month.
Yeah, not bad at all. So he asks his chartered accountant what he should do about taxes. His CA tells him not to worry, saying he doesn't need to register for GST until he crosses the standard 40 lakh annual turnover threshold.
Which is the classic advice.
Right. So Rahul thinks he has this massive buffer. But then in March, the marketplace just suspends his account for not having a valid GST identification number, or GSTI, on file.
Yeah. And the CA, in that scenario, he applied the logic of a traditional physical brick-and-mortar store to an online marketplace.
Which doesn't work.
Not at all. Under the current law, that advice is fatally flawed. The confusion really originates from two competing sections of the Central Goods and Services Tax Act.
Okay, break that down for us.
Sure. So Section 22 outlines that famous 40 lakh exemption limit for goods. And that was designed to keep tiny neighborhood shops out of the complex tax machinery.
Right, you don't want the local corner store drowning in paperwork.
Exactly. But then you have Section 24, specifically subsection 9. And this completely overrides that baseline for e-commerce.
So under Section 24, anyone supplying physical goods through an e-commerce operator must be registered for GST regardless of their annual turnover. Like, there is zero thresholds.
Zero. You have to be registered from Rupee 1.
It's basically like a roller coaster height requirement, right? For offline businesses, you must be this tall, 40 lakhs to ride. But for e-commerce, there's no height requirement. Everyone just needs a ticket to enter the park.
That's a perfect way to put it.
But let's pause here, because from an administrative standpoint, a zero threshold sounds absolutely insane. I mean, if someone is selling a single 500 rupee phone case, isn't the government just burying themselves in an avalanche of paperwork to track a microtransaction?
It definitely seems counterintuitive.
Yeah.
But that's until you look at the mechanism driving it, which is called tax collected at source, or TCS.
Okay, TCS.
Yeah, TTS is basically the central nervous system of e-commerce transparency in India. Whenever a seller makes a sale on a major platform, the law legally requires the e-commerce operator to deduct a 1% TCS from the payment.
Before they pass the rest of the funds to the seller, right?
Exactly.
So the platform is essentially acting as the government's automated tax collector on every single cart checkout.
That is the crucial dynamic.
Yeah.
And here's why the GSTN is so important. For the platform to deposit that 1% with the government on the seller's behalf, the digital architecture requires an account to attach that money to.
Oh, I see. They need the seller's GSTI.
Right. If the seller doesn't have one, that 1% tax just has nowhere to be routed. The entire chain of data breaks down.
But money's just floating in the digital ether.
Exactly. The government relies on that TCS data stream to monitor the exact volume of capital moving through the digital economy. So allowing sellers to operate without a GSTI It creates an unacceptable blind spot in their surveillance of capital flow.
Wow. So if you are listening to this and you're building a side hustle on Misho or Flipkart, you have to ignore the 40 lakh myth completely. You need that GSTI before you even list your first product.
You really do.
But that creates a massive operational bottleneck, doesn't it? I mean, if I can't make a single rupee without being registered, I cannot be waiting 4 weeks for government office to process my paperwork. Startups die waiting for compliance approval.
And the historical timeline was a severe pain point. I mean, manual scrutiny of applications routinely took weeks.
Which is agonizing when you're ready to launch.
Truly. But this bottleneck directly catalyzed the major reform that went live on November 1st, 2025, known as Rule 14A.
Ah, Rule 14A. Our sources refer to this as the 3-day fast track.
Yes, it is fundamentally a streamlined electronic approval mechanism designed explicitly for low-risk B2B suppliers and startups whose expected monthly GST liability, basically the total tax they owe, is under 2.5 lakh.
Okay, so under 2.5 lakh in tax liability. But how is the government actually processing new business applications in 3 days?
Through a concept called deemed approval.
Deemed approval. What does that actually mean in practice?
Well, the government shifted the paradigm from assumed suspicion to trust-based compliance for these low-risk profiles. If you apply under Rule 14A and the tax officer takes no manual action on your file within 3 working days.
Wait. So if the file just sits on a virtual desk and the officer is busy or, I don't know, goes to lunch for 3 days, the system just defaults to a yes.
Basically, yes. The portal system automatically grants your GST registration.
That is a radical departure from traditional bureaucracy.
It really is.
But there has to be a toll to get on that specific fast track. I mean, the government isn't just handing out tax identities on the honor system.
No, of course not. The toll is your biometric identity. The entire speed of Rule 14A is predicated on Aadhaar authentication. When you fill out your registration form, you're presented with the option to register under Rule 14A. If you opt in, you must complete Aadhaar verification.
And that's either biometrically or via an OTP tied to your linked mobile number, right?
Exactly. By instantly confirming your personal biometric identity against the national database, the tax authority neutralizes their biggest historical fear, which is the creation of fake shell companies.
So you are explicitly trading your biometric data for operational speed.
That's the deal.
What happens if an entrepreneur decides, they don't want to link their Aadhaar, or if they operate out of a rented garage and their documentation just isn't perfectly straightforward?
Then the system instantly pushes you off the fast track. It defaults you to the standard, highly manual route.
And what does that do to the timeline?
It immediately jumps from 3 days to a potential 30 days.
Ouch.
Yeah. The tax officer will issue a formal notice. You'll have to reply with additional documentation. And crucially, they will mandate a physical verification of your business premises.
A physical inspection. That is a massive friction point for a digital business. And looking at the operational details and the sources, this physical premises requirement is exactly where home-based sellers get crushed.
Oh, absolutely.
Because, a lot of startups begin in a spare bedroom. And using your home address as your principal place of business is legally fine. But if you rent that apartment, uploading your basic rent agreement will get your application rejected.
Right. Many new entrepreneurs assume a rent agreement proves their right to operate a business there.
But it doesn't.
The tax authority views it quite differently. They need explicit, documented confirmation that the property owner is aware of and consents to commercial activity occurring on their premises.
So what do they actually need you to upload?
You have to provide an electricity bill in the property owner's name, along with a no objection certificate, an NOC, from your landlord. It's just another layer of defense against temporary fly-by-night operations setting up fake addresses.
An NOC sounds intimidating, but it is literally just a plain piece of paper where the landlord writes that they are the owner and have no objection to you using the address for GST registration, followed by their signature.
That's all it is. Incredibly simple.
But if you omit that single sheet of paper, your fast-track application completely derails.
Instantly.
Okay, so let's say you do upload it. You submit the NOC, you authenticate with Aadhaar, and your file goes into the 3-day queue. Who is actually looking at this file to ensure the NOC is valid?
Well, in the 2026 landscape, it isn't a who looking at your file initially. It's a what.
A what?
Yeah, the GST network portal is now heavily integrated with advanced AI document screening.
Oh, wow.
In previous years, a human officer might quickly glance at a slightly blurry scan and just approve it. Today, The AI automatically intercepts and analyzes your uploads before a human ever sees them.
So it's acting like a digital bouncer at the door of the tax system.
That's exactly it.
But it's not just checking to see if your name is on a list, right? How deep is this AI actually looking?
It goes far beyond basic file checks. The system utilizes optical character recognition, or OCR, algorithms that tap directly into national API endpoints.
Okay, OCR. So it's reading the actual text on the images.
Yes. When you upload your PAN card, your permanent account number, which serves as India's primary national taxpayer ID, the OCR reads the text on your scan and cross-references it against the central income tax database. And it does this in milliseconds.
The sources highlight a pretty brutal example of this precision.
The spelling one.
Yeah. If your PAN card spells your name Mohammed with an A, but you typed Mohammed with an E on your digital application form, the AI catches that single letter discrepancy and automatically halts the application.
The tolerance for error is practically zero.
That's wild.
And it's not just text. The AI is also evaluating image quality and file parameters. If a PDF is blurry or if it exceeds a remarkably strict 1 megabyte file size limit, the system just flags it.
1 megabyte, that's tiny for a high-res scan.
It is. It basically forces the applicant to compress and clarify their data to ensure the automated systems can read it perfectly.
Dealing with 1 MB file limits and OCR matching sounds exhausting. What if a seller just decides the compliance burden is too high? They think, you know what, I won't sell on Amazon, I'll just set up an Instagram page, take payments via UPI, and run my business totally under the radar without a GST return. What is the actual risk of ignoring this entirely?
The financial penalties for attempting to bypass the GST framework in 2026 are severe enough to bankrupt a small operation.
Really? Bankrupt?
Oh, yeah. Selling taxable goods without registration carries a mandatory penalty of 100% of the tax due, or 10,000 rupees, whichever is strictly higher.
Wow.
Furthermore, the authority will levy an 18% annual interest charge on the unpaid tax, calculated for the very first day it was due.
So if we run the numbers on just a modest operation, it scales terrifyingly fast. Say a seller does 2 lakh a month in sales without a GST. Assuming an 18% GST rate, that is 3,600 rupees a month in unpaid tax.
Right.
Over a year, they owe 43,200 in back taxes. The 100% penalty doubles that to over 86,000. Add the 18% interest, and suddenly a small Instagram seller owes nearly 1 lakh to the government.
And keep in mind, a registration that would have been completely free on the government portal has now destroyed their working capital.
Exactly.
And that calculation doesn't even factor in the invisible cost of noncompliance.
Which is?
The total forfeiture of your input tax credit, or ITC.
Oh, right, ITC.
ITC is the fundamental gear that makes a value-added tax system work for businesses. When you operate, you pay GST on your expenses, right?
Yeah.
The cardboard boxes, the packing tape, your marketing agencies, your software subscriptions.
And a registered seller logs those expenses and claims that tax back. It acts as a credit against the tax they collected from their customers.
Precisely. It protects your profit margins. But if you choose to operate unregistered, every single rupee of GST you pay on your supply chain and operational expenses is permanently lost.
You just eat the cost.
You absorb it entirely as a cost of doing business, which immediately puts you at a severe competitive disadvantage against compliant sellers who are actively reclaiming those costs.
So the mandate is unavoidable. You have to register immediately, utilize the Rule 14A Adar fast track, and ensure your data compression and spelling are totally flawless to survive the OCR algorithms.
That's the baseline.
Okay, now let's assume our tech-savvy seller executes this perfectly. They have their GST on, they are active on the marketplace, and their products are moving. They want to scale. They decide to opt into Amazon's Pan-India FBA program or Flipkart's fulfillment network to offer next-day delivery to customers across the country.
This seemed to be where the compliance landscape turns into a complete minefield.
Right. I mean, expanding your fulfillment footprint without understanding the geography of GSTs is probably the most expensive logistical error a growing e-commerce brand can make.
Without a doubt. A GST identification number is not a blanket national license. It is strictly state-specific.
State-specific.
Yes. The very first 2 digits of your GST represent your state code. So 27 dictates your business is registered in Maharashtra. 07 means Delhi.
Let me clarify the boundary line here because this trips up a lot of new founders.
Here.
If I am operating out of a warehouse in Delhi, my GST starts with 07. If I pack an order in Delhi and hand it to a courier who ships it directly to a customer in Kerala, am I violating the state-specific rule?
No, you are perfectly compliant there. That transaction is classified as an interstate supply. You just charge integrated GST or IGST on the customer's invoice.
Okay, so I can fulfill orders to all 28 states and 8 union territories for my single deli facility using my one deli GSTN.
Yes, the physical movement of the package across state lines to the end consumer does not trigger a requirement for a new registration.
That makes sense. But the modern e-commerce consumer expects their package tomorrow, not in 5 days.
Oh, absolutely.
And to achieve that speed, I need to use a program like Amazon's FBA. So I ship a bulk load of my inventory to Amazon, and they store it inside their massive fulfillment center located in Kerala, so it is pre-positioned for local delivery. How does the tax authority view that?
See, that changes the legal equation entirely. The moment you store your physical inventory inside a warehouse located in another state, the law dictates that facility has become your additional place of business. GST is fundamentally a destination-based tax framework. State governments fiercely track and protect the economic activity and revenue generated within their geographical borders.
Because my physical goods are sitting on shelves in Kerala, the Kerala state government basically views me as having a commercial footprint in their jurisdiction, even if it's Amazon's building.
That is exactly the core logic. You cannot use your Delhi GST-9 to account for physical inventory resting in Kerala.
So what do I have to do?
The law requires you to obtain a completely separate, brand new GST-9, specifically in the state of Kerala. And during the registration process for that state, you're actually required to declare the specific Amazon fulfillment center as your official additional place of business.
Wow. This reveals the hidden danger of clicking opt-in on pan-India fulfillment. I mean, Amazon might distribute your inventory algorithmically across their network. They put some stock in Maharashtra, some in Karnataka, some in Tamil Nadu. What does that do to the seller's monthly compliance workload?
It multiplies it exponentially.
Because now the seller has physical inventory housed in 3 new states.
Exactly. They must actively manage 3 new state-specific GST-9s. And the burden isn't just acquiring the numbers, it's the recurring filing requirement. For every active GST-9, you must file a separate set of complex monthly returns.
You are filing a GSTR1 for your outward supplies and a GSTR3B for your tax payments, right?
Right.
So managing inventory in 3 states means filing 6 separate tax returns every single month instead of just 2.
And it gets worse. The system offers no leniency for slow months. If you have a month where your Karnataka warehouse makes 0 sales, you cannot just ignore it.
You still have to file.
You are legally required to log in and file a formal NIL return for that specific state's GST-9. If you fail to file, the portal automatically triggers a late fee of 20 rupees per day, which just accumulates until you resolve it.
It is the ultimate logistical trap. You click a button thinking you are just getting faster shipping speeds to boost your conversion rate, but on the back end, you have unwittingly opted into a massive, multi-state tax compliance nightmare.
It's a huge shock for a lot of sellers.
You really have to weigh the projected increase in sales very carefully against the sheer cost of paying your accounting team to manage multiple state filings.
Strategic planning becomes absolutely mandatory here. Before clicking that button, an entrepreneur must pull a platform inventory placement report, identify exactly which states the marketplace intends to utilize, and run a hard cost-benefit analysis on the multi-state compliance overhead.
Navigating the 2026 e-commerce landscape requires a completely different mindset than traditional retail.
It really does.
You cannot wait for the 40 lakh threshold because the TCS architecture demands you register from your very first sale. You have to utilize the Rule 14a fast track by offering your Aadhaar biometric data, and you have to ensure your uploaded PDFs are perfectly compressed and visually flawless to survive the AI's optical character recognition.
And finally, you have to fiercely guard your inventory placement, knowing that storing goods across state lines triggers a cascade of new GST-9s and monthly filings. You know, when you look at all these mechanisms functioning together, the mandatory digital registration, the biometric linking via Aadhaar, and the real-time AI cross-referencing of bank and PAN records, it reveals the ultimate trajectory of the Indian tax ecosystem.
Where is it heading?
It forces a rather profound question about the future of business compliance. I mean, as the government successfully merges these massive data streams in real time, how far are we from a reality where the entire concept of filing a tax return just becomes obsolete?
Obsolete. Like we wouldn't file at all.
Think about it. If the system's AI already knows exactly what inventory moved, what TCS was deducted by the platform, and what your exact tax liability is, the millisecond a transaction settles.
Right, they already have all the math.
Exactly. The next evolutionary step isn't making registration faster. The next step is the complete automation of tax deduction directly from digital wallets.
Wow. Rendering the monthly return completely a relic of the past.
That's where we're headed.
The digital architecture is already in place. They just need to close the final loop on the automated payment. That is a fascinating evolution of this system, and something every digital entrepreneur needs to watch closely. Thank you for joining us on this deep dive into the realities of GST compliance. Stay curious, protect those seller accounts, and keep building.